Joining us now to talk more about the weak economy and the strong stock market is William Delwiche. He is a market strategist with Robert W. Baird. William, welcome. Good to have you with us. A Harry Potter market, a dream world market. You heard what David Darst just said. Do you agree with that?
Well, I think to some extent, yeah, that's certainly a disconnect between what we see in the economy and what we see in the stock market. The stock market's hitting all-time highs while the economy is still stuck in first gear, 3 years after recession ended.
So what is it going to take for the economy and the stock market to track each other better, in like more normal, in the way it is in normal times?
Well, I think first we should step back and realize that the market and the economy can move away from each other for an extended period of time. But given that, to get them back kind of on the same page, I think we need policymakers to get out of the way and uncertainty in D.C. start to fade, and then those underlying positives in the economy can start to kind of bubble to the top, and we can start to get going again.
So you seem to be saying that the disconnect between the economic fundamentals, between, say, corporate fundamentals, earnings, and stock prices can be persistent for long periods of time. Do you think we're obviously in that kind of situation right now? What could derail it and send everything going the other way?
Well, I think an aggressive backing away from easing by the Fed would be one thing to look at, but I don't think that's likely to happen. They know kind of the boat they're in, and they know what's going on, so I don't think they're going to step back aggressively right now. And until then, you'd have to see some weakness internally in the stock market, or really excessive optimism on the part of investors, and that isn't present just yet.
And the economy is pretty weak, about 1% growth, maybe 2% growth. What do you see as the speed limit for the economy looking ahead?
Well, I think in the immediate term, I think 1.5% to 2% growth is about what we can expect. But if you step back and think about it, 2% growth and really low inflation, that's not really an altogether bad situation for stocks historically. So as long as we continue to have low inflation and some growth, I think the stock market can continue to muddle higher.
No, and you've also got very low interest rates, which reduces the cost of capital for and makes borrowing more more accessible to more companies. What sectors of the stock, if you had some discretionary money to put to work right now, even at these prices, where would you put it sector-wise?
The three sectors we're looking at right now are consumer discretionary, industrials, and materials. Those are the strongest sectors in the market right now. They've been strong for a while.
But why consumer discretionary if the consumer's low on confidence and they're not really spending all that much?
I know that's the ironic thing, is that you can construct an argument about why that would be a bad sector to be in, but the reality is that that's a sector that continues to move higher, and at the end of the day, it doesn't matter what you think might happen. What matters is what is happening, and what is happening is the consumer discretionary stocks are rallying and they continue to move higher.
William, thank you very much for your help tonight.
Sure.
William Delwiche of Robert W. Baird.